I'll introduce myself to you. My name is Ralph, and I think I am on the course outline, but if you want to contact me, it's ralph.zurbrugg@adelaide.edu.au. And I'll actually be taking I'm helping out Gary, so I'm taking the rest of the lectures for the remaining semester, but you will see Gary again because I think, as you are probably aware, there's a futures trading simulation that you have to participate in, and he will be offering tutorials and workshops on how you trade. And so you will be seeing him again anyway in the next few weeks when you start learning how to trade. So I'll be just simply focusing on taking the rest of the lectures for you. So what are we going to be doing today? I'm going to introduce you to something that very different from what you covered before the mid-semester break, which is to look at futures contracts. And today's going to be relatively easy, and the reason being, all I'm going to do is introduce you to the futures market. So there's nothing really complicated to go through. It's more about an introduction of how the futures markets function, a little bit of its history. And then also, this would only last for about an hour. The second hour, I'll actually be showing you a video. And the video is on your first case study relating to the options market on long-term capital management. It is examinable, but the examinable part basically relates to a couple of research papers that I think are made available to you on the MyUni website. If not, they will be made available to you by Gary. So the video lasts for about an hour, and it's about the largest institutional collapse in the world that happened in the late 1990s. So although it's very old, over 20 years old, long-term capital management still is the largest financial loss of any institution. It's a hedge fund in the world. They had an exposure of over $1 trillion at one stage. And the people who headed up long-term capital management were the people who created the Black-Scholes-Merton option pricing model. So it's quite interesting to follow. It tells you the history of how the options pricing model was developed and created, and then how these people try to make money from it. But unfortunately, they lost. Okay, so what I'm going to do, as I said before, start off with this topic 6. This will only take us about an hour. And when we start talking about futures contracts, it's very different. And let me see if I can switch it onto both panels, the PowerPoint presentation. It's thinking about it. Well, it might come on, I'm not sure. When we talk about futures contracts, futures markets, they're relatively straightforward to understand compared to options. And what we're going to be focusing on is defining them, in particular the difference between forward contracts and futures contracts. There's a slight difference between the two, so we'll focus on what that is. We'll talk a little bit about the historical development of them, as I mentioned before, and how you actually trade futures and their contract specifications. So, the difference at the end of the day, between an option contract and a futures contract, both of which are the two primary types of derivatives which are traded in an exchange. There are other types of derivatives, financial derivatives. Can someone name me one? They're not just options and futures. There are other types of financial derivatives. Anyone can provide me with swaps? Swaps is another one. Yeah, there's quite a few. But the reason why this course, and many people, if you go to a university, focus on options and futures is because these are the two most heavily traded in an exchange. Swaps actually have a very large transaction volume, but they are primarily over-the-counter. What does over-the-counter mean? Can someone remind me? That's right, they're not traded in an exchange, okay? So basically, unlike exchange-listed options, ELOs, and exchange-traded futures contracts, they're over-the-counter, or is what we call OTCs. And they are basically managed differently. So this course, as when people first introduced derivatives, is focused on those derivatives which are traded in exchanges. And primarily they consist of options and futures. There is in fact only one major difference between them, between options and futures. Can someone tell me what that is? Sorry? Yes, yes, very good. There is, at the end of the day, no difference. Fundamentally, of course there are small differences, but fundamentally there is only one major difference between a futures contract and an options contract. And that is, an option has a right but not an obligation. In fact, this is not technically correct either, because you only have a right and not an obligation on certain type of positions on options. What are they? When do you have a choice, a right? Only half of the time when you're trading options do you have a right. The other 50% of the time you have an obligation. When's the 50% of the time that you have an obligation, you don't have a right? Yes, very good. When you short. If you short an option, when you short a call option or a put option, doesn't matter what it is, you have an obligation. If I've gone short on the option and I basically have taken the short position, you've taken the long position, you decide to exercise, I have no choice. I have to pay out what is due to you. So in fact, when we talk about a right but not an obligation for an option, we're really referring to those people that are taking a long position. If you're taking a short position, you only have an obligation, and it's very remarkably similar to that of a futures contract. The primary difference, though, between futures and options I've just highlighted is that there is no right whatsoever. It doesn't matter if you're taking a long or a short position in futures contracts, you have an obligation. If I have gone long on a futures contract today, it tells me I must pay something in the future. If I've gone short on a futures contract today, it tells me I must deliver something in the future. There is no choice. Now this makes, of course, calculating futures contracts remarkably easier than calculating options contracts. If, for example, I want to work out the value of a futures contract today, does anyone want to guess how I would do that? It's actually very simple. You know the answer basically already. A futures contract is a contract for you to pay for receiving something in the future. How do you think you'd calculate that? It's not the present value, it's not the discounted value. What is it? It's the future value. You know the future value formula, right? At the end of the day, of course, next week when I go on to explain the model, it's a little bit more technical than that, but what it boils down to is that a futures contract, a forward contract, is equal to the future value of the principal amount. That's all it is. If you know the future value formula, you basically know how to calculate futures contracts. It's that simple. It would also be simple for options. You'd also be able to calculate the option contract as a future value. If it were not for the fact there is a choice here, right? And this makes things very difficult. Because if you have a right but not an obligation, then the question is, how do I value that right? How do I work out that choice? That's a very complicated matter. And what it comes down to at the end of the day is that you have to rely on a probability distribution, you have to make assumptions on where you think prices will head. It becomes a very complicated decision-making process. So the reason why options are so complicated to calculate is only because of this right but not obligation. That makes it basically complex. Okay. So what is the difference between forward and futures contracts? They are basically the same thing, apart from the fact that a forward contract is traded over the counter. They are not in an exchange. It's an agreement between two parties that call for the delivery of an asset at a future point in time with a price agreed upon today. So two parties get together. Usually it's a couple of banks or a couple of institutions, businesses, and they agree to swap money and an asset at a future point in time at a price agreed upon today. Futures contracts specifically refer to forward contracts that are exchanged in an exchange, in a bourse. They are standardized, which basically means you can have multiple futures contracts which are identical to each other. So I can take 5 futures contracts on orange juice, for example, or wheat, and they're all basically identical to each other. With forward contracts, they're individual. They're quite unique because they're agreed upon by 2 individuals to meet their specific needs. Now, I've included this cartoon because it gives you an example of what futures markets are all about and highlights a very important concept that I'm going to explain, and it's quite hard to initially understand, and it's one of the few, what I say, nuances, complications in studying futures contracts. So this cartoon is from the United States, and in the US, when it gets very hot during summer, it's quite common that kids, so here you've got a young boy, will try to sell lemonade on the street to people that walk by. But this boy here is quite entrepreneurial. He's gone one step further. He is not selling lemonade. He's selling lemonade futures. And as you can see, this businessman walking by, he might be very thirsty and wants to purchase the lemonade. And so when he goes up to the stall, the boy will have to say, well, I don't actually have any lemonade now, right? What I can do is offer you a lemonade futures contract. So if the businessman purchases a futures contract for lemonade, how much do you think the businessman pays the boy now? Let's say the lemonade futures cost $5. That's the futures price. When the businessman agrees to go long on 1 lemonade futures, how much would he pay for it now? Yeah, someone said 0. That's the correct answer. This is a futures contract. With a futures contract, do you pay anything now? No, you pay nothing now. What does the businessman receive now? A contract, right? Nothing else, right? Doesn't really receive anything. When does the businessman have to pay the $5? Yeah, in the future, right? In the future. And when does he receive the lemonade? In the future. Okay, so what is the value of the futures contract today? When the businessman buys the futures contract today, what is the value of it? It's not $5. $5, as we will talk a lot more about this next week, is what we call the contracted rate of future purchase. It is how much I agree to pay for the lemonade in the future. The futures price only tells me how much I'm going to pay for it in the future. So, when we compare futures contracts to other type of financial instruments, it doesn't matter if they're stocks or bonds, options, real estate, it doesn't matter. When I talk about value, it is the same as talking about price. If I say, what is the price of BHP shares today, and you say the value is $25, that's the same thing. Value is equal to price. But it's not the case with futures contracts. Only with futures is there a difference between value and price. And this is something that you have to keep in mind, because as we shall see next week and furthermore the week after, you have to distinguish between the two. The price is the contracted rate of future purchase, is how much you are going to pay in the future. So if the businessman pays a contract for $5, it's telling us how much he will pay in the future, not how much he pays now. He pays nothing now. So what's the value? Well, the answer is quite simple. I've sort of given it to you already. If the businessman pays nothing now and receives nothing now, what has to be the value? Zero. It has to be nothing. You're not paying for anything, you're not receiving anything. So value at the start of a contract, when you go long or short, it doesn't matter, of a futures contract, the value will always be zero. So in my simple example, the lemonade futures contract price, the futures price is $5, the value is zero. So I'm just setting that up now. It's something that we're going to talk a lot more about next week. But that basically is one little difference that futures contracts has with other type of financial instruments. Now, in terms of how futures markets have developed over time, they in fact have been around for quite a few years. And if you go back historically, you can see some examples of futures trading, not necessarily how we are familiar with it today, but nevertheless there were futures contracts. The first example I'm going to provide you is that of something called laissez-faire, which is basically a letters of offer. And in the 1100s, particularly in France and the United Kingdom, these letters of offer were traded between merchants. Now, there wasn't a stock exchange in the 1100s, but particularly in certain cities around Europe, such as in London and also in Amsterdam, in particular Netherlands, it was quite common that if you wanted to trade stock or these letters of offer, which is like a futures contract, you'd actually go to a pub, you go to a bar. And the bar that you go to depends on what you want to trade. So how traders worked those days was very different from now, right? So basically you wake up in the morning, you go to the bar, you start drinking alcohol, and then you start trading. That was basically how things worked out. And basically what these letters of offer were, if I decided to, for example, offer one, I would be a ship merchant. And France and the United Kingdom were usually at war with each other, one stage or another. So, for example, I might say I've got two ships that are going across to France from England, and they're raiding the villages, capturing as much gold and valuables as they can, ship it back to London, and then I'm offering you the value of the contents of my ship, the loot, right? What we'll be able to capture. Now, when you're trading this, you do not know the value of what's going to be captured. It might be nothing. The ship might be sunk. On the other hand, it might be very successful and bring back a lot of money. You just don't know. So, if I start offering you this, you are speculating on the future value of the ship, but you offer me a price for it now. So I'm happy because I'm given I know no matter what happens, I'm going to receive for my ships a certain amount of money, and you're speculating that it'll bring back more than you're going to pay for it. Now, the trade, of course, occurs in the future. You pay for the money when the ship returns, and you receive the goods when the ship returns. So nothing is traded now, it's traded in the future. So this basically is a futures contract. Another example that I can provide is in Japan during a period of time when they had various warlords that controlled different areas in Japan. So they were referred to as shoguns. So in the 1700s, shoguns used to trade tickets with one another. So these tickets were for what we call rice entitlements. And if you basically were a warlord, a ruler of a certain area, and you needed more rice, you could go to other rulers and purchase these rice entitlements, these tickets. You pay for it at a certain price that's determined today, but you pay for it in the future when the rice is harvested. So again, this is another form of a futures contract. So if you look around the world, you actually find examples of futures markets being visible, futures contracts, but it's not similar to what we're sort of more familiar with today. The first example of a modern-day futures contract was in 1848 in the Chicago Board of Trade, and it was for commodities. Most futures contracts up until the 1970s are what we call commodity futures. Therefore, purchasing and selling different types of commodities, whether it's agriculture, it could be rice, wheat, orange juice, cattle, or it would be for metals like gold and silver. So anything that's sort of related to a real asset, a commodity, that's basically what most of the trading was on. Here in Australia, for example, the first traded futures contract was in 1959, and it was traded on the Sydney Greasy Wool Futures Exchange. The Sydney Futures Exchange no longer exists. It was bought up by the Australian Stock Exchange in the year 2000. But before that, the Sydney Greasy Wool Futures Exchange traded just one particular futures contract, and that was greasy wool. If you get a chance to feel wool when it comes off of the sheep, it is actually greasy. So that's where it gets its name from. And the reason why this was traded is because if you go back to the mid-1950s, the Australian economy relied on selling commodities, primarily such things as wool, to the United Kingdom, its old colonial ruler. And there in England, they would make clothing out of the wool and sell it back to Australia. That was basically the economic model. And so people in England wanted to know what they would have to pay for the wool in the future. And farmers here wanted to know how much they would get for their wool in the future so they can work out their pricing. So the establishment of the wool futures contract was because of the economy, how basically trade functioned. So the purpose of these futures contracts is to facilitate trade because it can reduce risk. If you are, for example, a simple example, a baker, and you rely on flour to make your bread, it would be good to know how much you're going to be paying for your flour for the next 6 months, right? So purchasing a long futures contract on wheat would be quite helpful. This is also true for the farmer. The farmer wants to know how much they're going to be able to sell their wheat for in the future so they know what they can buy in terms of new equipment, new seeds, more farming, manure, stuff like that. So there is a benefit from reducing risk by both the buyer and the seller coming together. In most cases, and we'll be talking about this more next week as well, in reality nowadays, even with commodity futures, most trading during the life of the futures contract are by speculators. So you might really have a farmer and also a baker taking positions. But they're the ones that want to hold it till the end. They want to trade. In between that, you have all this trading that occurs. They're really from speculators, people guessing whether the price is going to go up or down. And so you have a mixture of people who are hedging, who want to minimize their risk for buying or selling a good, and at the same time you have speculators who are trying to make money in between. So we will discuss how that basically leads to an ebb and flow and ups and downs of the futures contract during the life of it. The major activity of what we call financial futures, and when I'm talking about financial futures, I'm referring to, for example, stock futures contracts or indexed futures contracts, and more so also what is referred to as the FX forward market. So, the foreign exchange market in futures contracts, in forwards, is probably the largest type of financial market there is in the world. Trillions of dollars are traded every day around the world. And this started up in the middle of the 1970s. And it's referred to as the international monetary market. Does anyone know what happened in the mid-1970s? Sorry? A recession? No. The US economy was growing very, very fast, in fact. Sorry? Yes, there was an oil crisis, that's true. It's partly related, but not exactly what I'm looking for. Yes, that's very good, that's correct. So, if you go back to the 1970s, before the 1970s, every currency around the world was pegged. What do I mean by pegged? The Australian dollar, I don't actually know what the rate was, but we'll make it up. We'll say 5 Australian dollars bought 1 US dollar. And that was set, that was fixed. It didn't vary. And the US dollar was also fixed. What was it fixed on? On gold, that's right. I do not remember anymore the exchange rate, but it's something like 2 or 3 ounces at that time of gold for 1 US dollar, no, for 100 US dollars, something like that. So the exchange rate was fixed in terms of how much US dollars bought in terms of gold. That was how the system functioned before the mid-1970s. What happened, though, in the middle of the 1970s is that the US economy was growing very fast. 5-6% per annum, very, very fast. And in order for the US dollar, for the government, the US government, to print money, to make more US dollars, as the economy grows, you have to dig more gold out, right? But if you can't dig out gold quick enough compared to the amount of money you want to print because the economy is growing very fast, what type of economic policy do you have? So here I'm talking about money supply, right? So I'm referring here to how quickly the money supply is growing. If you have an expansionary monetary policy, it means you're printing lots of money. You're making money easy to get hold of. Money is cheap. If you have a contractory monetary policy, it means you're restricting money. You're making it very hard to find the US dollar. So the US dollar has greater value. So what type of policy do you think is basically being followed? If you can only print money if you find gold, but the economy is growing very fast, but you can't get enough gold from the ground. What's growing faster, the economy or the money supply? The economy. So you've got a contractory monetary policy. You basically want to print more money because you want to keep it in alignment with the size of the economy. As the economy grows, you need to print more money. But if you can't do it at the same speed, you're restricting it. And so this causes a lot of problems. And what the US government decided to do, I think it was in 1974, I can't remember the exact date, they decided they will no longer follow what's called, as the gentleman mentioned, the Bretton Woods system, or what we also call the gold standard. The gold standard is where the US dollar is related to gold, and all the other currencies are related to the US dollar, and therefore by default to gold as well. So nowadays, the Australian dollar, like the American, the US dollar, and the euro, even the renminbi in China, more or less, it's a sort of a controlled exchange rate, but still it's sort of true. They basically are not related to gold. What are they related to? What is the US dollar value related to? Sorry? Yes, you can call it fear. Basically, it's to do with confidence. How much confidence you have in the economy. If you think the economy is strong, then you're feeling more comfortable at holding the currency, right? So if we, for example, look at the Afghanistani dinar, right? You don't know if the government's going to be there next year, so you don't know if the currency is going to be valuable. So you holding the Afghanistani currency is very risky, right? So the reason why different currencies around the world also have different interest rates is related to the confidence you have in the economy and the currency. So, for example, in South America at the moment, there's a lot of political instability. Brazil, for example, the president has been impeached. He might go to jail. Argentina, they have lots of problems as well. So the interest rate is high. The interest rate is high because you want an incentive as a foreigner to invest in the currency, right? Otherwise, you won't hold it. You'll hold the US dollar. So, at the end of the day, what you have given birth to if you do not have the gold standard, and basically you have what's called a fiat currency. Fiat is F-I-A-T. That's what most currencies around the world are now, fiat currencies. They basically mean you are essentially relying on the confidence you have in the country, in the economy. Suddenly, you want to trade. Every single day, every single minute, millions and millions, billions of dollars are traded every single day around the world of working out what the Australian dollar is to the US dollar, for example. Because people have different expectations, which economy is getting stronger, which economy is getting weaker. So this trading has basically given birth to the largest financial market in the world, which is referred to as the International Monetary Market, or IMM for short. You can also call it the interbank market. It's where banks around the world trade currencies all the time. There's also heavily traded in swaps, currency swaps as well. This, of course, has led to, when we talk about futures contracts and forward contracts, nowadays most of them are financial futures, not commodity futures. So before the 1970s, commodity futures would be the largest type of futures contract that were traded, but nowadays it's financial. So just to give you some examples of some large exchanges around the world, and these are primarily commodities here that I'm listing. If you want to, for example, trade energy or grains, such as different types of wheat, you'd go to the Chicago Board of Trade. If you want to trade livestock like cattle or pigs, etc., then it'll be the Chicago Mercantile Exchange. In Asia, the largest commodity exchanges are in Japan. You've got the Tokyo Commodities Exchange and the Tokyo Grain Exchange. In London, it's probably the largest market for metal. You go to the London Metal Exchange for trading metals. So depending on what you basically want to focus on, what you're trading, you go to different type of exchanges around the world. I'll give you some examples of what Australia trades a little bit later on. In China, there is what we call a fledgling futures market. They've just basically sort of started one. And I don't think it's too successful at this stage. So in China, you don't have options, you don't have futures contracts. You do have them in Hong Kong, though. You have both options and futures contracts. So one of the problems that you have, of course, and you would know this in China, is that if you go back, more than maybe 3 or 4 months ago, you know that the index went down, right? And then the government decided to buy the stocks. So this causes a big problem. Why? Because, as I'm sure Gary has highlighted before to you, what's the most important ingredient to value a derivative? Most important ingredient. Most important factor. Doesn't matter if it's a futures or option. You need to be able to have confidence in what the underlying value is. Right? If you don't know what the underlying price is, how are you going to price the derivative? You cannot. So the problem is that in order to have a futures market, you first must have confidence that the price is established fairly and correctly for, let's for example, say the stock. So only when you have what we would say a relatively efficient stock market or bond market can you start talking about having a futures market or a options market. Otherwise, no one's going to be willing to trade it. So in China, there is a couple of futures contracts, but they're not heavily traded. The reason being, people don't know how to price the underlying correctly. So you're only going to be able to trade the futures once people have confidence in the underlying. So that's basically the answer. But you do have futures contracts, for example, on dual-listed Chinese stocks that are basically what we call in the A share and the H share market. I don't know if you're familiar with that. So there's some stocks listed in Shanghai, for example, that is also listed in Hong Kong. And they will have futures contracts on them. So, but you'd have to primarily trade them in Hong Kong. Okay. So when we focus a little bit more on the differences between futures and forward contracts, then of course there is a little bit more difference than just talking about whether one is traded in an exchange and one is not. So with forward markets, another difference is that you have what's called default risk. What is default risk? It is the risk that one party reneges. That means if I make a deal with you and then tomorrow I disappear, you have nothing to back onto, right? Sometimes you can go to the law courts and you can ask to fine me and for me to make me pay up, but it's quite difficult. Sorry. So the risk of one party reneging is this risk that the counterparty, let's just make sure we understand the lingo here. We have two parties. If I am one of those parties, then the other is referred to as the counterparty. So sometimes we call this counterparty risk. That means the other person, the other institution that's making a deal with you cheats. Okay? That's default risk, counterparty risk, same thing. You do not have that in futures markets. Why do you not have that in futures markets?
It's traded in a regulated exchange.
It is traded in an exchange, but why does that make it that you do not have any default risk? I might trade a futures contract in it. I might go long on a futures contract. You have gone short and you are ready to deliver to me and I disappear. So you get no money.
The other party have to pay a certain margin to be able to.
That is true. I agree with you. We'll talk about that. That is true. It's a separate issue though. Who is covering the risk? That's the question I'm asking. The exchange. That's right. The reason why you want to exchange in an exchange, to trade in an exchange, is because the exchange itself will cover the risk. So you don't have to worry about me running away, because the exchange will come in and pay what's due to you. So they eliminate default risk. Now the problem is, and you've rightly pointed this out, the issue of course is the fact that, well, if the exchange is taking on this risk, the question is, why would they do that? Are they going to do that because they love you, because they feel good about you? No, right? So they want you to trade in the exchange, because every time you trade, there's a transaction fee, right? They make money from that. At the same time, they have to encourage you to trade with them. So they'll say, if you trade with me, there will be no default risk, right? There will be no default risk. But then the problem is, I have to find a way for me to minimize that default risk. And the way I do that is through holding what's called margin trades, margin accounting. So I'm going to talk about that very soon in a few slides. The idea is, essentially speaking, is that if you want to trade a futures contract, it does not matter if you go long or you go short, you must post a deposit with me. You must give me a little bit of money, and I hold on to that. And who holds on to it really is called the clearinghouse. The clearinghouse is the building, you could say, right, that basically keeps a record of what you own, right, the inventory, and they also hold what are called margin accounts. And they look after your money. And every day, if you lose money or you make money, then you have to pay the clearinghouse or you receive money from the clearinghouse. So that on any given day, if you decide to renege, if you decide to run away, how much risk does the exchange have to forfeit, has to take on? If you make money on one day, you receive that money. If you lose money on the day from the futures trading, then you have to pay the money. So if you decide to run away before the contract expires, how much risk has, in fact, the exchange have to carry? One day's worth of trades. So I will explain this through an example. But basically what is happening every single day, if you're making money or losing money, you have to basically receive or pay the clearinghouse, the margin account. And the reason that's done is not for your benefit. You don't want margin accounting. The reason why it's done is for the benefit of the exchange, because they limit the risk that if you decide to run away, you've already paid all the losses you've accumulated before that day, right? They only have to cover 1 day's worth of losses before they try to close out your position. So we'll have a look at that an example in a second. Another advantage, of course, of trading in an exchange is that futures contracts are standardized. They are not unique contracts. And that basically means it's easier to get out of a position. If you decide with a friend to organize and create a forward contract, and then the next day you don't want it anymore, you have to find someone who wants to take your position. But it's quite unique. The forward contract is unique between two parties. With futures contracts, it's much more easier. If I have gone long on one futures contract today, and tomorrow I don't want that contract anymore, all I have to do is go to the market and go short on the same futures contract. In reality, this is sort of interesting, you can never get out of a futures contract until the termination date. If I go long today on a futures contract that matures in 10 days' time, I have to wait until that 10 days goes and then have it terminated, right? The reason being, remember, a futures contract is an obligation. But what I can do is take an opposite position. Sometimes we call this an offsetting position. That means that if I've gone long on one futures contract today, then tomorrow I go short on another futures contract. My net position is 0. I have +1 long, I have +1 short, well, that's a negative sign, so that's 1 minus 1 gives me 0. So even though I'm holding those two positions till the termination date, basically my net position, my net exposure is 0. So that's how it sort of functions in the futures market. If you want to construct a forward contract, there are a number of websites, institutions around the world that have been set up, associations, that provide what are referred to as master agreements. And one of them is the International Swaps and Derivatives Association. You can download the ISDA master agreement from the website, and literally if you fill it in with another person and you sign it, then you have a forward contract. And that is legally binding in a lot of countries. So here in Australia for sure. There's about 3 or 4 master agreements from different associations that you can use. But once it's signed, it becomes a legal contract. And that basically means that if the other party reneges, you can try to seek what we call restitution. That means you can try and get your money back in the law courts. How successful you're going to be, I don't know. The other problem is, of course, the law will cost you a lot of money. You have to hire lawyers and they charge very high fees, right? So a lot of the times you don't bother, because even if you can get the money back, the cost of getting the money back is higher than getting the money back to begin with. So you just don't bother. That's how it is. Now, there are different stipulations that these master agreements include, such as what happens during liquidation, non-payment, how the arrangement's going to be made with payment, how the bank transfers are going to occur, the conditions and specific terms of the contract. They're all specified within the master agreement. The organised futures exchange avoids you having to work out a specific contract. The contract specification is already given to you. You have no choice but to take what the terms are from the exchange. I will show you an example of a contract specification in 1 second. Before I do that though, the other thing I really want to highlight here is that, and again it's something I'm going to talk a little bit more about later on, is that futures contracts have what are referred to as delivery cycles. What is a delivery cycle? Well, it basically means that, as with options, futures contracts only live for a certain period of time. Let's say they only live for 12 months. Just before the contract expires, the exchange will create a new contract. And that contract will live for another 12 months. So you have what we call a cycle. Every month, usually, another contract is created for one that's just about to die. So if you look at, for example, index futures contracts here in Australia, they have roughly a 6 or 12 month cycle, but they're created every month. That means at the end of April, very shortly, there will be a futures contract that's going to be expiring. That started 12 months ago. But just as it expires, a new contract will be created today or tomorrow that's going to live for another 12 months. So what you can do is what we call rollover. Rolling over means that just as a futures contract expires, and if I've gone long, I short the contract and go long on the new futures contract which just has been created. Suddenly I've got another 12 months to live. So, I don't know, this is maybe not the best example I can think of, but it's sort of, let's say you're about to have a heart attack and someone gives you electric shock, right? That gives you a little bit extra time. That is sort of what basically is happening with a futures contract. As one futures contract comes to an end, you can quickly get out of it, go into the next one that gives you an extra lifespan. So that's what's called rolling over. You roll over your lifespan of the futures contract before it terminates. Now we talked about having a margin account. So margin accounting, sometimes it's also called mark-to-market accounting, and also it's sometimes called daily settlement practice, mean the same thing. Daily settlement, mark-to-market accounting, and margin accounting are identical in meaning. They tell you the process of how the exchange tries to minimize its default risk, its counterparty risk, because it doesn't want to carry it. And the way it does that is to require any position that you take with a futures contract, whether it's long or short, to post an initial margin. You have to post an initial amount of deposit. Now, in the margin account held by the clearinghouse, you must have amount of money that is equal to or above what's referred to as the maintenance margin. This is therefore a buffer zone that exists between the initial margin and the maintenance margin. The initial margin is going to always be higher than the maintenance margin. The difference between the two is your buffer. As long as you're within that buffer, you do not receive a margin call. What happens if your amount of money that you have in your maintenance margin drops below, how much money you have in your margin account drops below the maintenance margin, is that you receive a margin call. You're told by the exchange that you must post more money. How much money do you have to give back into the margin account? It has to go back up to the initial margin. So I'm going to show an example of that. So basically, long story short, you put a bit of money in to the margin account. As long as the money that you have in the margin account is above the maintenance margin, you're fine. If it drops below, you have to post money back up to the initial margin. So there's a cycle there, continually goes on. And this is called mark-to-market accounting. Now, the question that you might ask is, what is going to be the initial margin? I don't think Gary covers this in much detail, so I'm not going to make a big deal about it. The way in which an initial margin is set is through something referred to as span margining. Span margining is short for a standard portfolio analysis of risk. It's a certain technology, a technique, that was created on the Chicago Mercantile Exchange in 1998 to look at 16 different types of scenarios in how the futures contract you're taking a position in might go. It might go up, it might go down, volatility may be low, it might be high, and it works out what is the highest risk scenario. The highest risk scenario leaves us with the scanning risk. And this basically, at the end of the day, is the one that is set to determine the initial margin. So the more risk that the futures contract has, the higher the initial margin that you have to post. So at any given day, if I trade the same futures contract, the amount of margins I have to post, the initial margin, can change. It changes on a daily basis, based on the risk associated with that futures contract. So I've already mentioned this before. The process of mark-to-market is referred to as daily settlement. And if the balance falls below the maintenance margin, you receive a margin call. And this, therefore, leads for you to make additional funds available to the clearinghouse. And these additional funds are referred to as a variation margin. So I am slowly running out of time, so what I'm going to do is just show you the contract specifications, and then when we meet next week, I'll go into detail in providing an example of the margin accounting. But you can read it for yourself, the example of margining on the SGX, the Singapore Exchange. What I'm going to do, though, is just cover the contract specifications at this stage. So, the reason why I'm looking at the SGX Middle East crude oil futures contract is because it's a very important futures contract for Australia and also for Asia, including China. The reason being that around the Asian-Australian peninsula area, if you want to work out what the price for petrol that you're going to pay for your car is going to be in 1 week's time, it will be determined by the price of this contract here. As we know, petrol is a derivative of crude oil. And the largest exchange for setting crude oil prices in Asia and Australia is in Singapore, and it's referred to as the Middle East Crude Oil Futures Contract. It's traded in Singapore. It's a standardized contract. Now you might think, well, that's a bit strange, because I never knew Singapore made oil, produced oil, right? It doesn't, of course. We have to look at the contract specifications. We find out that the underlying is, in fact, the average of the Dubai and Oman crude oil price. So two Middle Eastern countries that are known for producing oil, that's where basically the oil price is set, and is the underlying price that we use in Singapore to speculate on what future prices are going to be. Now, this is quite interesting, and this is true for most futures contracts around the world. Futures contracts are not for trading for people like you and me. The reason being, unlike options contracts, they involve large sums of money. And here's a simple reason why. A single futures contract on crude oil has a contract size of 1,000 barrels. Does anyone know how much 1 barrel is equal to? Sorry? Oh yeah, okay. So in terms of price, I'm thinking in terms of in liters, in volume. It's about, I don't know exactly, but it's about 250 liters. So 250 liters is equal to 1 barrel. So is this the type of contract you're going to purchase yourself? Not really, right? Unless you've got a very big garden where you can store loads of barrels and then find a way of refining it. This is not going to be of interest to you. So this contract, a single contract, is going to cost a lot of money, and is on a large sum of, or large volume of oil. The contract lasts for 6 months, and as you can see, the trading hours are listed between 8 a.m. and 7 p.m. in Singapore. Because most trading in Singapore occurs from foreigners abroad, it also provides you what those trading hours in other countries. So for example, in London, if you're in London and you want to trade this Singapore contract, it's going to be between 1 a.m. and 12 p.m. in London. We also have the final settlement price, the position limit. This is interesting because position limits did not exist before the Barings Bank collapse. So that's something we're going to talk about later on as well, where someone manipulated futures contracts and led to basically a whole collapse of a bank. So no individual can own or control more than 5,000 contracts, net long or short. That means there's a limit on how many positions you can take on a contract. So these didn't exist up until 1998 when it was imposed. And then you've got price limits, which exist in most markets around the world. So prices can't deviate by a certain amount to try to control for volatility. Okay, as I mentioned before, what I'm going to do is talk about the example next week. And what I'd like to do now is take just a short break, so a 2-minute break, and then I'm going to show you the video. Okay.